All right. Good morning, everyone. Welcome to today's webinar on tax-free savings accounts and registered retirement savings plans and the benefits of each. It is about a minute past 10 o'clock, so let's get started. For those of you who I have not met, my name is Jacqueline Ozdemir. I'm a financial advisor with Asante Capital Management and team member with Ferguson Financial Planning. I will also be the host of today's session. So, sorry, just fixing my camera here a little bit. A lot of you would have received an invitation through our newsletter, but a few of you signed up through our Instagram account. So I thought coming into the session today, you might have a few questions about, exactly what it is we're going to be talking about and what you can take away from this webinar afterwards. So some of the questions I thought you might have coming into today's session is, what is the purpose of this webinar? What can I expect to learn during this webinar? And what should I do after this webinar? So that's kind of what we're going to talk about during the session today. Now, before I jump into anything, I just want to remind everyone that today's session has been set up as a webinar. That means that you can see me, but I can't see or hear you. I've done this intentionally just based on the number of participants we have today and the fact that I am going to be recording this webinar. I just wanted everyone to be able to remain as anonymous as they'd like, because this will be posted on our YouTube channel and our website in the coming week. So just because I can't see you and we're not together in person doesn't mean this still can't be interactive. Depending on the device you're using to listen and watch today, there is a feature, if you sort of scroll at the top or the bottom of your screen, you'll see both a chat feature and a Q&A session feature. Feel free to click on any of these if you have any questions. As I'm going through the presentation today, you have the option to post those questions, and I will try my best to answer them as I'm going along or at the end of the session. So I expect today to be about 40 to 45 minutes, obviously depending on the number of questions we get as we go throughout. It is a webinar, so if you have to drop off, no worries, life happens. And remember, I am recording this, so you can always come and watch it at a later date. And if at the end of the session, we find that we're getting a lot of questions, I will stay on as long as needed to help address all of those. Okay, so diving into things, the purpose of this webinar today, well, obviously we're going to talk about RRSPs and TFSAs. On our team at Asante, we offer a really wide range of financial planning services. So this goes from tax and estate planning, insurance planning, investment management and advice, and also retirement cash flow planning. And sort of throughout all those different services we offer, one topic that comes up a lot is, what is the difference between an RRSP and a TFSA? Which one should I be contributing to? And how does this play into my overall savings goals and also my estate plan? Okay, so that's what we're going to be learning about today. Specifically, the topics that we're going to be going over are things like, what is a TFSA and an RRSP? And I should point out, I recognize that we have a really broad audience today of people joining. Some folks here today already have TFSA and RRSP accounts, might already be investing at Asante. So this session today will probably be a really good refresher about why you're using these accounts and how they're helping to serve your financial goals. For other folks joining today, I know that are new to investing, today is going to be a really great opportunity to learn about these different types of accounts and help make some educated decisions on how you should be proceeding with your savings going forward, okay? So we're going to cover some of the basics, like what is an TFSA, what is an RRSP. We're going to talk about things like, how much money can I put into each? What types of investments can I hold? And maybe what types of investments should I be holding in these accounts? We're going to be talking about, if you don't have the means to put money into both types of accounts, does it make sense to do a TFSA, or does it make more sense to do an RRSP? Also, we're going to talk about whether you can put your savings into both types of accounts. Then we're going to start talking a little bit about a topic that not a lot of people like to talk about, but I think it's one that's important, and that is the tax implications on death. So what happens to these accounts when I pass away? And are there taxes owing? Then, once we've taken all of that and we're complete experts about what a TFSA and an RRSP is, we're going to talk about different strategies, so different ways to use these accounts and different ways that you can reduce your taxes, okay? Again, this will be a really great refresher for some folks, and for others, it will be a really good learning opportunity, okay? Finally, the last question that I thought you might have as you come into this webinar today is, great, I'm going to learn a lot. What should I do afterwards? So some of the topics that we covered today are going to be relevant to you, and some of them aren't going to be as relevant. So what I urge you to do is maybe focus on one or two things that you think are applicable to you and act on it after this webinar. So it might be something as simple as actually setting up a tax-free savings account if you don't have one and contributing to it. Or it could be something like pulling out your wills and powers of attorney and making sure that your beneficiary designation is correct on these types of accounts, okay? So those are the types of things that you might want to do after this webinar, after you've learned a little bit more about those topics. So jumping right into things, I want to do a review of what a TFSA is, what an RRSP is, and how they have some similarities and how they have some differences. So right off the bat, I want to point out that both a TFSA and an RRSP are an investment account, okay? You can think of both like a bucket. Everyone has a bucket and it's a certain size. You can put money into it and you can invest in it. The term tax-free savings account is a little bit misleading. When they were first rolled out in 2009, the banks did a really good job of promoting them as a glorified savings account. So a way to put money into and just save a little bit and maybe make a little bit of money, invest in something like high interest or a GIC. In fact, TFSAs are so much more than that. You can invest in a wide range of investments, okay? And it is a tax sheltered investment account. This means that when you put money in, if you invest it, if you have growth on those investments, that is tax-free to you. An RRSP is also an investment account. So again, it's a bucket, you have a certain amount of room, you can put money into it, invest it, and hope that it grows. I refer to this as a tax sheltered investment account. I should probably call it a tax deferred investment account because at some point you will be paying taxes, and we can talk a little bit more about that as we go on. Another thing to talk about is, are deposits tax deductible? So we're currently in January. You might be hearing people say like, oh, got to make an RRSP contribution before the end of February, before I file my taxes in April. Why are people talking about that? When we put money into an RRSP, we are effectively reducing our taxable income. So for example, if I made $100,000 last year and I put $10,000 into my RRSP, it's like I only made $90,000. So I made $100,000 during the year. I paid taxes off my paycheck as if I had earned $100,000. So I was in a certain tax bracket. I paid a certain amount of taxes. When I go to file my 2020 tax return, I'm showing CRA that, yeah, I made 100, but I contributed 10. So really I made $90,000. But throughout the year, I actually paid taxes as if I was making $100,000. Therefore, the amount of taxes I should have paid is less. And therefore, I might get some sort of tax refund, or I might get some sort of tax reduction of what I owe. So if I owe taxes, I might owe less. If I don't owe any taxes, I might actually get some money back. That is why an RRSP is tax deductible. When I put money into the TFSA, CRA doesn't really care. I'm not going to get any sort of benefit when I file my tax return, okay? So for that reason, TFSAs, you don't save any money on your tax return when you put money into it. But for an RRSP, when you put money into the account, you do save some money, okay? Now, let's fast forward a little bit. Are withdrawals tax-free? So say, for instance, I've put $10,000 into a tax-free savings account. I invested in something really awesome, and now my $10,000 is worth $30,000. When I go to take that money out, again, CRA doesn't see it, doesn't really care. I have $30,000 of tax-free income, okay? So it's totally, totally tax-free. An RRSP, on the other hand, it was great. I put money in, I saved a few bucks when I filed my tax return. I'm taking money out. So my $10,000, let's say, has grown to $30,000. I decide I'm going to withdraw $30,000. That is taxable, okay? The amount of taxes you pay and the amount of taxes you save is all dependent on your tax rate. So if you're earning $100,000 a year, you fit into a certain tax bracket. So when you put money into your RRSP, the amount of money you're saving, or sort of the amount of tax you're getting back, is equivalent to the amount you put in times your marginal tax rate, kind of. I mean, that's kind of a rough formula of how you can calculate it. So if you're making a lot of money and you put money into your RRSP, you're going to save a lot on taxes. In the future, when you go to withdraw for this account, or withdraw from the account, typically in retirement, your income is less, you're in a lower tax bracket. So the taxes that you're paying when you actually go to withdraw these funds is still hopefully less than the taxes that you saved when you put money in. Okay. And again, this has to do with proper planning and making sure that you're putting money into an RSP when it makes sense to do so, and making sure that you're withdrawing from the RSP again when it makes sense to do so. At any time, we want to be conscious of how much taxes we're paying. And so with proper planning, you can make sure that you're saving some money when you put money into an RSP and spending as little taxes as possible when you take it out. Okay. So this is great. These are both investment accounts. I can put money in, and regardless of what type of account I'm using, there is some tax savings to be had. So, I got a bunch of money in the bank. Why don't I just put everything into my TFSA and my RRSP account? Unfortunately, there are limits. So we can't just put everything we have into these accounts. We'll talk about the limits in a minute, but what you need to know is you can't just put all of your life savings into these accounts, okay? You might be limited. Other things that are important to note is whether or not a beneficiary can be named. So when you pass away, what happens to these accounts? When we die, we can have different assets with us, especially if we've built up wealth over time. Some of these assets can be passed directly to a beneficiary without having to go through a will and without having to go through probate. I won't go into too much detail about what that means, but what you need to know is that you can actually assign a beneficiary on the account level. So I might say that when I pass away, I want my spouse or I want my kids to inherit my TFSA, and I might say the same for my RSP. This point's going to be important later because we're going to find out that by assigning a beneficiary, you save a little bit on taxes, okay? But it's important to know that these types of accounts can have a beneficiary. There's other types of accounts out there, for example, an open or a non-registered account, which is also a form of an investment account, but you cannot name a beneficiary on it, okay? So with these ones, you can. I mentioned earlier that when you take money out of your RSP, it is taxable, okay? There are some exceptions to this. When I take money out of my RSP to fund a first-time home purchase or to pay for additional education for myself. Now, today we're just going to focus on the first-time home purchase. But if I take money out for that purpose, I'm not going to incur taxes. So if I'm a first-time home buyer and I've saved up money in a TFSA and I've saved up money in my RSP, I can use both to help me fund that down payment. Now, with the TFSA, regardless of how I'm spending it and what I'm using the money for when I withdraw, I'm never paying taxes on that money, okay? So I've kind of lumped TFSA into this category saying that, yeah, sure, if you have a TFSA and you're buying a home for the first time, yeah, sure, you can use it toward your down payment on a home. That's fine, no problem. You can also use it to fund a vacation. You can also use it to buy a rental property. You can use it for anything, okay? Including a first-time home. For an RSP, you can take up to $35,000 and use it on a down payment on a home. Okay, you obviously have to have at least $35,000 in your account to do that, but you can take $35,000 out, not pay taxes, and use it for that home purchase. The only catch here is that you are required to pay the money back over a period of 15 years. So, if you find yourself in this category and you are buying a first-time home, you can talk to us about the RSP withdrawals. Also, your realtor or maybe your mortgage agent will be able to help you assess whether that's appropriate as well. Okay, so finally, can the money stay invested forever? So you might think, well, I'm going to save in these accounts and then I'm going to spend the money because it's my money and I want to spend it. And yes, absolutely, you should do that if you want to do that. For some folks, what happens is they have these accounts and they find that in retirement, maybe they have other sources of income or they have a really great pension and they don't find that they're actually, they saved up in these accounts, but they never actually spent the money because they didn't have a need to take the money out and they really wanted to take advantage of the fact that they were tax sheltering the growth in these accounts. So sure, if you have a TFSA and you open it up and you put money in and you never ever spend it, you can die with that account having never spent a dollar. This is not necessarily true for an RSP. So at some point in time, you have to take money out of your RSP. This isn't like a bank rule or an Asante rule. This is a government/CRA rule. So how it works is the year you turn 72, you have to start taking money out of this account, okay? When you were contributing to the account earlier on in your career or in your life, you were saving a few dollars, right? When you put money into the RSP, you got some sort of tax refund. The government is eventually going to want some of this money back. And so therefore, they're going to start making you withdraw from the account in the age you turn 72. So when you turn 71, you are required to convert your registered retirement savings plan into something called a registered retirement income fund, or a RIF. I won't spend too much time talking about that because this session is about RSPs, but what you need to know is that at age 72, you are required to start taking money out of it, which is essentially just your RSP that is now called a RIF. The amount you have to take out is a percentage of the value of the account. Okay, so for example, if I am 72 years old and I have $100,000 in my RRSP account, I have to take out about 5.5% this year, or about $5,500. That's just the rule. And guess what? When you take that money out, it is taxable. So you can see the importance of proper planning to make sure that when you're putting the money into the RSP, you're going to be taking it out at a time when hopefully your income is lower and you're not paying too much in taxes, okay? Because that money will be taxable when it comes out. And don't worry, if you're someone on the webinar today and you're thinking, oh my gosh, I'm 69, how am I going to remember that I need to convert my RSP to a RRIF in a few years? Don't worry, we will call you and we will set it up into a RRIF for you, okay? And talk about how you want to withdraw those funds. So we know now that a TFSA or an RRSP is an investment account, and I can take money out, I can put money in, I can invest the money, and it can be used for different purposes. With a TFSA, when I take money out, it's not taxable. When I take money out of an RSP, it is, okay? So how much can I contribute and who can contribute? So just kind of like everything else, when it comes to dealing with CRA and the government, nothing is really simple. And of course, the contribution rules and limits and who can contribute is different between a TFSA and an RRSP, okay? So we'll just sort of go through how they differ. For a TFSA, it's a little bit more simple. Anyone who's 18 or older is allowed to contribute. The TFSA was rolled out in 2009, which means that anyone born in 1991 or earlier has been able to contribute since this thing was first launched, okay? For an RSP, it's a little bit different. You can contribute to an RSP account if you have earned income and if you filed a tax return, okay? So what is earned income? Earned income for most of us is going to be simply our paycheck, our salary, our bonus. So whatever we kind of make from our employer, that is earned income. For other people, it might mean it's income from a business that you run on your own or in a partnership. It could be income from a rental property. It could be royalty income if you're an artist. It can also be spousal support payments, okay, that you received. It does not include employment insurance from the government. That does not count as earned income. So, I mean, technically, a 16-year-old can have earned income and file a tax return. I personally have never come across a 16-year-old opening up an RSP account, but technically it would be possible, okay, because they have that earned income. So then how much are you allowed to contribute? For a TFSA, it's a little bit more clear cut. Everyone gets the same amount of contribution room each year. So when this was first launched in 2009, I think the limit was you were allowed to put $5,000. So if you opened up a TFSA in 2009, you were allowed to put $5,000 in. The next year, I think maybe it was $5,000 again. So in 2010, you could put another $5,000 in. Because this has been around since 2009, the amount of room that's been added, the sum of that is about $75,500 as of today, okay? This means that if you were at least 18 in 2009 and you've never contributed to a TFSA before, you could put in $75,500, okay? That's how much you could put in today. If you're someone who's contributed every year, then every year you would check to see, okay, what's the new TFSA limit? I can put that amount in going forward. For an RSP, the amount that you're allowed to put in each year and the amount that you're allowed to put in sort of, if you've never put in before and you're gonna make one big contribution this year, really depends. So the amount of additional room that opens up to everybody each year is a formula, and it's the lesser of 18% of your income or a maximum set by the government. So for example, if I just started working this year and in 2020, I made $100,000. that means I am allowed to put $18,000 into my RRSP. If I made $154,000, I can put $27,000 into my RSP, which is about 154,000 times 18% works out to about $27,000. If I made $500,000, still the new room that opens up is $27,000 for me, okay? Because that's kind of the upper limit. Now, if I've been working for 10 years and I've never once contributed to an RSP, the amount that I could put in this year, if I wanted to, is the sum of all those previous years that I didn't use, okay? So if I have $100,000 of RSP contribution room that I've never used, I could theoretically make $100,000 RSP contribution this year if I wanted to, okay? One question that came up before the webinar, and someone asked when they registered, is where can I check my contribution room? So for your RRSP, this is pretty simple. When you file your tax return, you'll get a notice of assessment, and your notice of assessment will state how much RSP room you have, okay? And it's pretty well tracked, so it's pretty accurate. So for example, go back, check your 2019 notice of assessment, and it'll show you how much room you have for 2020. When you go to file your 2020 tax return in a couple of weeks, you'll get a notice of assessment to say, okay, for 2021, how much you're allowed to contribute. For a TFSA, it's a little bit more complicated. You have to go onto the CRA website, and there's a path you follow, and you'll find the section that talks about TFSAs and contribution room. If you want to see that and you don't know how to find it, send me an email and I will send you the path and the links to follow to find that. Just a word of caution, the TFSA tracking that CRA does is not as accurate as the tracking they do for RSPs. So if you've had a TFSA and you've closed it, you've opened another one, you put money in, you took money out, I would really urge you to track that appropriately and just make sure that it lines up with the records that CRA has, okay? Because the best record keeping for this is going to be the ones you do for yourself. If you've opened up an Asante TFSA, we track that for you. However, it is up to you to know what happened before you opened up a TFSA at Asante, because the tracking that we do for you is only as good as the history that you give us before you came over to Asante. Okay, so I have a question, and this is actually perfect, is can you speak to the impact of withdrawals from TFSAs on future contributions? Absolutely. So that was actually on my next slide. What happens to my contribution room if I take money out? Okay, so the question is what happens to future contribution room when I take money out? When you take money out of your TFSA, it really depends on whether or not you can put money back in. Generally speaking, if you take money out, you can put it in the following calendar year. So for example, if you're someone that has taken out, you've put in the maximum amount each year. So you have put in a total of $75,500 of your own money. When you take that out, you have to wait. So if you take it out in 2021, you'll have to wait until 2022 to put that back in, okay? Another example is if you've put in $75,500 over the course of, since TFSAs have been opened and your investments have grown and now maybe they're worth $100,000, it's 2021. If you take out $100,000, you can then put in $100,000 next year plus whatever the new room is, okay? So you can see it's actually possible to create more TFSA contribution room through investment growth, okay? If you were someone who is 30 years old, put in $6,000 into a TFSA this year in 2021, and then in November you pull it out, and then in December you come across a large sum of money, you could put in about $69,000 back into your TFSA this year. You can't put in the $6,000 that you took out this year, but you can put in all that old contribution room that you never used. You could use it in this year. But again, if you've maxed out your TFSA every year and you take out the whole balance of the account this year, you have to wait until the next calendar year to put money back. And I was going to talk about this later, but I'll mention it now because I think it is relevant. One of the things I said is if you put money into your TFSA, you invest it and it grows, you've created more contribution room. So if you take out all the money, you have more room to put money back in later. It always goes the other way. So for example, if you put in $75,000 into your TFSA over the course of your life, or since they've been open, and you invest in something very speculative, so maybe you invest in like one stock and that stock plummets, and now your $75,000 goes down to $30,000. When you go to take that $30,000 out, you can put back money next year, but you can only put in $30,000, okay? You lost your contribution room, so you can't top it up to $75,000 again. You have to wait for the investments to grow that high, okay? So just something to be cautious of if you're using your TFSA for speculative investing or for day trading, okay? I talked earlier, can you carry forward unused contribution room? Yes, you can. So again, if you're someone maybe in your 30s or 40s who's never opened up a TFSA, never contributed to a TFSA, maybe you never even heard of a TFSA until you logged onto this webinar today, you have that room available. Just because you didn't use it in the past doesn't mean it's not available to you today. And the same goes true for an RSP, okay? Another question that we get a lot is, can contributions be made on behalf of my spouse? So, you know, a lot of times when we have partnerships, maybe it's a spouse or it's a common law partner, chances are one spouse makes more money than the other. And in some instances, it's quite a large gap. So anyone can open up a TFSA, you don't need to have an income. So even if your spouse doesn't have an income, they can still open up a TFSA and contribute. A lot of times when we're meeting with clients, if that's the case, when they make TFSA contributions, the money is simply coming from a joint bank account, $6,000 to one person, $6,000 to the next person, okay? For an RSP, the idea is that money you're putting into your RSP is your money, okay? So it's money you earned, you have contribution room, you're putting money into your RSP, it's coming off your RSP deduction limit, you're getting the tax refund. There is an account you can open up though, specifically for a spouse and specifically for situations when one spouse is making significantly more than another, and it's called a spousal RSP. So if I want, I can set up a spousal RSP for my husband. If I'm making more money than him, I'm in a higher tax bracket. What I do is I take some of my money and I put it into his spousal RSP. Okay, that contribution I make to his spousal RSP counts towards my RSP contribution limit. I get the tax refund on my tax return, but that money in that RSP is essentially now his for him to control and for him to withdraw in the future. The reason people would do that, and we'll talk about it more later, is that in the future, now when me and my husband are both retired, we both have RSP accounts. Instead of mine just being really big and him having a really small or non-existent one, we both have a medium-sized RSP and we're taking money out at a lower tax bracket, okay? So we're saving a little bit on taxes. And finally, you know, can I overcontribute, and what happens if I overcontribute? So for a tax-free savings account, no, you're not allowed to overcontribute. I've seen it a few times before where people might have had multiple tax-free savings accounts opened, lost track of how much they've contributed, and they get a letter from the CRA, kind of a little slap on the wrist saying, take the money out or we're going to start charging you a 1% penalty a month on the overcontribution, okay? Same goes for an RSP. You can, you know, it's possible to overcontribute. It's not like you're going to get halted at the bank when you try to make an overcontribution, but you will get a notice from CRA if you've overcontributed. I say that you can overcontribute because you have about $2,000 of flex room. So in your lifetime, you can overcontribute $2,000. So if I have $10,000 of RSP contribution room and I make a $12,000 contribution, that is technically okay. I just can never do that again. Okay, so you kind of get one chance to overcontribute by about $2,000. And we'll talk a little bit later. There might be one or two instances where strategically that makes sense to overcontribute just that tiny bit. Okay. Another question that came up again in when people register for the webinar is, can I put money into an RSP after I retire? Technically, yes, you can. So if you retired in 2020, for instance, my father-in-law retired in 2020, it's now 2021. We're still sort of for RSP contributions in the 2020 tax year. I asked him if he wants to make one final RSP contribution that would be applied against his 2020 income. Generally though, and again, with proper planning, it might make sense to make an RRSP contribution, but when we're retired, we're making less money. We might be not making any earned income, so we really can't be making an RRSP contribution. And again, it might not make sense, even if you were technically retired, but had a little bit of earned income through a part-time job. If you're not making a lot of money and you're in a really low tax bracket, it might not make sense for you to be contributing to an RRSP again. Okay, so that's something we can help you out with if that situation is applicable to you. So now that we know, that TFSAs and RRSPs are investment accounts and that they offer really great tax sheltering, and that in RRSP, we're going to get taxed a little bit when we take the money out. We also now know how much each of us is allowed to contribute. How and what should you be investing in? So I want to just remind everyone that a TFSA is not just a high interest savings account. It is something that you can actively invest in, okay? So right now I've listed out a bunch of different things that technically you can invest in your TFSA or RRSP. Again, your TFSA and your RRSP is like a bucket. You have a certain amount of room. You can put cash in, money, and then you can invest it. I've listed out a few things here, not really in any particular order. I think in my mind, when I did this, I kind of went from, okay, what's the most aggressive, most growth-oriented types of investments down to the least conservative. So we have things like stocks or exchange-traded funds, liquid alternatives, which are kind of like hedge funds, but available to the general public for investing, mutual funds, bonds, GICs, high interest savings. So probably things that a lot of you are very familiar with or at least have heard of. How you should be investing in these accounts is so unique to every single person. But sort of high level, things that we first look at when we're talking to folks about how they want to invest in their TFSA and RRSP is, what is your time horizon? So how long do you think you're going to leave these funds invested? Are you retiring next year? Or are you 30 years old and you're not touching this account for 30 years? So we consider things like time horizon. We also consider things like your personal preference for risk. A lot of times when I'm talking to newer investors, both young and old, I get, sort of the saying, oh, you know what, I'm really risk adverse and I don't want to lose anything. And they're invested in GICs and high interest savings. And that's fine. But kind of once we peel back the layers, we really discover that it's not that the investor is risk adverse. It's that they just don't know about other types of investments or how sometimes investing in something higher growth might actually pay out in the long run. So for example, if you're a younger investor and you have an RRSP account, for example, and you say, you know what, I already own a home. I'm not taking this money out for anything, or at least I don't think I'm going to. This money, I'm putting it aside. I'm going to save for my retirement. In that situation, I might recommend going with a more growth-oriented portfolio. We know that over time, markets go up and down. It's what they do. A lot of us will remember 2008, 2015, and then again last March. In every instance, the market did recover. So while some of these higher growth assets have potential to dip a lot more during those economic dips, they also have the potential to go up a lot more as well. So if you are a long-term investor, investing in higher growth assets might make more sense for you, okay? Because you have the time to ride out the market cycles as things go up and down, and ultimately markets tend to trend upwards in the future, okay? So that might be if you have an RRSP. Now, if you have a tax-free savings account and you're thinking, I've put money aside here and I might be using it to fund a vacation, or I want to do some renovations on my home, I might recommend doing something a little bit more conservative, especially if you're coming in and telling me that, you know what, I've saved up this money. I'm going to need to pull it out in 6 months, but I don't want to be totally out of the markets. What can I do? I might recommend scaling it back a little bit. So doing something that's a little bit more conservative so that if we do hit a big dip in the market cycle, your portfolio will not be impacted nearly as much. Okay, so we're almost kind of taking some money, parking it on the side because we might need to pull it out again soon. Other things I just want to point out is today we're talking about tax-free savings accounts and registered retirement savings plans. There are other types of investment accounts out there. One of them that we work with a lot is a non-registered or an open account. Unlike a TFSA and an RRSP, a non-registered account really gets no tax sheltering. So any taxes that are incurred on your investments, you're totally exposed to that, okay? So you might actually on your tax return be filing things like dividend or interest income or capital gains. That's because you have an investment in an open account. And that's usually what I might recommend to someone who wants the flexibility to take money in and out as much as they want, but has maxed out their tax-free savings account. So these different investments that I've listed here all carry different sort of tax treatment as well. So stocks are taxed a certain way, mutual funds, bonds, GIC, high interest savings, they all carry some level of tax with them, okay? It's important to make sure that if you do have different types of accounts, like an open account, a TFSA, and an RRSP, not only are you investing appropriately based on your time horizon and your risk profile, but you're also placing the right types of investments in the right types of accounts. It doesn't make sense to put some types of investments into an open account because you're just going to get so many taxes on that, okay? So if this is something that you think might apply to you, if you have a pretty diversified balanced portfolio, a few tweaks could be necessary just to make sure that you're taking the most tax advantage of the tax sheltered accounts and that you're not exposing yourself to unnecessary taxes, okay? That could be avoided by a little bit of reshuffling of the investments within the accounts. So, we've kind of talked about some of the basics when it comes to TFSA and RRSP investing. So for those of you who maybe don't have any of these accounts or only have one or really aren't sure where to start, how do you know which one you should be opening if you have neither, but you don't have the resources to be able to be contributing to both right now? Generally speaking, I recommend someone opening up a TFSA that has a low income right now, because remember, when you put money into an RRSP, you get that tax deduction. The greater your income, the larger the tax deduction. Okay, so if you're new to working and you're not making as much money as you think you might be making in 5 years, it might make sense to do a TFSA. Also, if you know that you need the money immediately for something other than a home purchase, investing in a TFSA might make more sense for you. Okay, because it gives you the flexibility to take money out without incurring taxes. A TFSA might make sense for someone who wants to do some really high growth investing and so needs to shelter a lot of taxes. A TFSA is going to be your best bet for that. Also, a lot of folks who work for an employer like a large corporation or for the government are might have some sort of group RRSP or pension plan available through their employer. Okay. In that case, a TFSA might make more sense because when we contribute to a group RRSP or we contribute to a pension plan, that is actually sort of like that's contributing to an RRSP. Okay, so you're already getting that deduction. An RRSP might make more sense for someone who has a high income now. So is in a high tax bracket. So when you make those RRSP deductions, you're getting a big tax deduction. But also knows that they're going to have a lower income later. So they might not have a hefty pension from a previous employer. And in retirement, they're really relying on their savings to fund their retirement. This is going to give you that advantage where you save a lot of taxes in your working years when you're contributing, and you pay less taxes in your retirement years, okay? Also, with the exception of that first-time home buyers, an RRSP is great for someone who knows that they're probably not going to need the money for retirement. Because what we don't want to do is, if it can be avoided, have you withdrawing large sums from your RRSP when you're in the middle of your working career and you're kind of at your highest income level. You're going to be just paying a lot of taxes, okay? I don't see any more questions coming through. Remember, if you have any questions, you can put them on the Q&A or in the chat feature. So let's continue on. The next question, I guess, can I have both? Absolutely, you can have both types of accounts. So for example, if you have a high income, you might want to be making RRSP contributions, but if you have a lot of savings that you want to save and maybe spend in the short term, a TFSA might make sense. Again, if you have a high need for tax sheltering, you definitely want to take advantage of all the tax sheltering types of accounts that are available to you. So like an RRSP and a TFSA. And as well, if you have various timelines. So I talked earlier about the investor who's younger, who knows that they're saving for retirement in their RRSP, but also has been saving in the TFSA because they have something coming up maybe in the next 5 years. Absolutely would make sense to have both. One investment or one account, the RRSP can kind of be used for those long-term savings. And the TFSA could be potentially used for some of those shorter term expenditures, okay? So we're going to talk a little bit now, shift gears a little bit about the tax implications at death. So we've talked about how these accounts for the most part are fairly tax sheltered, especially the tax-free savings account. But what happens if you've saved into these accounts and you haven't spent all the money by the time you pass away? So I mentioned earlier that you can assign a beneficiary to both your TFSA and your RRSP. A beneficiary can really be anyone that you want. So it can be, it could be your brother, your sister, a neighbor, a friend, or it can be your spouse, okay, or a common law partner. And there's definitely a distinction made between a beneficiary as sort of your neighbor, friend, sibling versus your spouse or common law partner. When you pass away, if you have assigned your spouse as your beneficiary, when you pass away, that account, your RSP or your TFSA, basically kind of rolls over to them. They assume ownership of your RSP and your TFSA, and it kind of becomes their own. It doesn't matter if they don't have any TFSA or RRSP contribution room left. They kind of just get whatever you had, and that's it. There's no taxes owing at that point in time. If you assign a friend or a neighbor or sibling to your RSP as your beneficiary and you pass away, it's like you sold everything in your RSP the day before you died, and it's like you withdrew everything. If your RSP is worth $500,000, for example, when you pass away, that would be taxed at 50%. So $250,000 right away is going to the government or the CRA, okay? And then your inheritor would get the rest of the funds, okay? Or sometimes what happens is it gets a little bit messy, and I won't go into too much detail, is your estate winds up paying the tax bill, and that can create an area of conflict in some families. So if you have a spouse or common law partner, and if your intention is to leave them your RSP when you pass away, you should make sure that they are assigned as the beneficiary on your RSP, okay? Because a lot of taxes can be paid or due if you assign someone else as a beneficiary. Now, in some cases, you don't have a spouse or common law partner, so that's your only option. TFSA is a little bit more forgiving. Again, if you assign your spouse as the beneficiary, when you pass away, they will just get your TFSA. If you assign someone that's not a spouse or common law partner, there could be a little bit of taxes owing, and that will be the difference between the account value. You know, if you die and the account was worth $100,000, and by the time the account's liquidated and it's been given to the beneficiary, just say the account's worth $105,000, there could be about taxes owing on that $5,000, but not nearly as significant as an RSP. Okay. I see a few questions coming through. One of the questions was, does the 50% tax implication apply if your child is your beneficiary? Yes. Again, if someone other than your spouse or common law partner is listed as the beneficiary, the 50% tax implication does apply. So again, it's upwards of $250,000. If that's the account value, that's where we start to see that 50% tax. If your RSP is only worth $10,000 when you pass away, the taxes are going to be a lot less. But as we start to see accounts that are greater in size than $250,000, that's where we're going to start to see some of that 50% tax implications. Another question we had, sort of going back to the first-time home buyers, is if you're not a first-time home buyer, is there any options or benefits to use that money to invest in real estate? So I think the question is asking, can you use things like your TFSA or your RSP to invest in rental property? For that, I would definitely recommend investing, using your TFSA funds to buy a property if you're not a first-time home buyer, okay? Now remember that if you have a rental property, the income you earn from that, the net rental income, counts towards your RSP contribution room. So if this is going to be your main source of income, you will still be able to contribute to an RSP using the money that you've earned off your rental property. Okay. So now that we've learned, a little bit more about these types of accounts and about the tax implications on death and about how we can invest in it, let's spend a few minutes before we wrap up talking about different strategies that we can employ with these types of accounts. So taking everything we've learned so far, I'd like to point out that when we're investing in these types of accounts, it's really important to think long-term. So I talked earlier about how for a younger investor, or maybe someone who doesn't have a very high income today, investing in a tax-free savings account might make more sense. Okay, so think about when you open up these accounts or when you're investing in them, what is the purpose of this money? Is it to invest in something, or is it to pay for something in the short term, or is it to save for something in the long term? Because that is going to impact maybe what type of account you're opening up, and it also might impact how you're investing. Okay. Another key point is make contributions early in the year. So I talked earlier about RSP contributions. We are in 2021. Obviously, you can still make an RSP contribution till the end of February of 2021 and have it count towards your 2020 income, okay, when you file your tax return. That is a rule. It's the first 60 days of contributions. So that's a lot of people do. A lot of people might not contribute during 2020, but then say, okay, I kind of know how much money I made in 2020, so I'm gonna make a decision on how much I should be contributing to my RSP, and I'm gonna do that before the end of February in 2021. As well, for TFSAs, for someone who is in the habit of investing the maximum amount each year as new contribution room is awarded to them, invest early in the year. The longer you're invested in the markets and the longer you're invested in a tax sheltered account, the greater their potential for growth and tax savings longer. So if you were planning on investing in your TFSA at some point this year, you might as well do it at the beginning of the year. It's going to be a longer time your money's invested. And it's going to be more tax sheltering. So even though it's maybe a couple months earlier, you're going to contribute than you were planning, over time, this will add up, okay? Next point to consider is plan when you're going to take, plan when to apply your RRSP contributions to your tax return. So what I mean by that is you can make an RSP contribution today. So, January, I'm gonna make an RSP contribution. You don't have to apply it to your 2020 tax return. You don't have to apply it to your 2021 tax return. You might decide you're gonna apply it in 2023. So just because you've made the contribution doesn't mean you need to apply it to your tax return. You could kind of hold on to that and apply it later when your income is higher and you'll get a bigger refund. A situation where this might make sense is maybe someone who was working in 2020 had been making large RSP contributions earlier on in the year, got laid off, and now all of a sudden their income for 2020 is a lot lower than what they were expecting. So they might decide to hold off a couple of years to officially apply that RSP contribution to their tax return to get a bigger refund, okay? Another example is, for instance, when I was on maternity leave, I was still contributing to my RSP, but I wasn't making as much money, right? Because I was just collecting employment insurance. So I'm going to hold on to those RSP contributions I made. They're in my account, they're earning money, they're tax deferred, but I'm going to wait until this year to apply them when my income is higher, okay? Now that I'm back working full time. Another option or another strategy, and I'm probably guilty of this, is save, don't spend the refunds from your tax return. Okay, so it's really nice when we file our tax return and we get a little bit of money back. I mean, that's kind of awesome. Don't spend it if you can avoid it. I mean, it's very tempting, but remember, the money you're getting back in your refund is really just a repayment to you of taxes that you overpaid earlier in the year. It's not free money. You're just getting the money back that you overpaid, okay? So different strategies that might make sense is taking those tax savings and maybe put it into the tax-free savings account if you haven't already maxed out for the year, or save it and make an RSP contribution next year, or use it to pay down your debt. Okay, so those are all other options that you could do instead of just spending it. I talked earlier about over contributing. So I don't necessarily recommend over contributing to your RSP, but you do have $2,000 of wiggle room. So there could be an instance, for example, if you've maxed out your RSP, you're in a super high tax bracket, which means that when you make an RSP contribution, you're going to get the most amount of money back on your tax return. In that instance, it might make sense. Or if you're doing a pension buyback, which again, if this sort of sounds like it might be relevant to you, we can talk more about it later. But in that instance, it might make sense to over contribute by that $2,000. Okay. Another question that came up is, can you somehow shelter your RSP in trust accounts to avoid high estate taxes? So I'll have to address that later. The short answer is that yes, there is some sort of tax sheltering you can do, but at some point you're going to have to take the money out of your RSP and it will be taxable then, okay? But for you who asked that question, I will follow up with a more detailed response on how that could be applicable to you, okay? Other things to consider is doing spousal RSP contributions. This is a really great way to split income in the future. So this would allow you and your spouse to have sort of more of an equal amount of savings in the future, which means that when you're both withdrawing from your RSPs in the future, or then your RIF accounts, instead of one person being having a really big RRSP account or RRSP account, withdrawing and getting a lot of taxes, both of you would have more medium-sized accounts. Also remember that if your spouse passes away, they can still make one last spousal RRSP contribution, okay? So as the executor, you would be able to arrange making one last spousal RRSP contribution and just save them a little bit of money on that final tax return, okay? Other strategies to consider are invest appropriately, okay? We talked earlier about different time horizons, different risk profiles. Make sure that you are investing the right types of investments in the right types of accounts and that you're aligning your time horizons and your goals correctly, okay? If your goal is to save a ton of money and to get really high growth, you're not necessarily going to achieve that by investing in GICs. Again, if you need the money in a year to pay for a big home renovation, investing in very speculative stocks might not be the route to go because you're going to risk there's a greater potential for loss there, okay, if the market turns sideways. Other things, make sure that you've assigned your beneficiaries correctly. We talked on a previous slide about how RRSPs can be taxed, especially if you haven't assigned a beneficiary correctly. Now, this really is a whole topic. We did cover this in a past webinar called The 7 Deadly Sins of Estate Planning, which is available through our website if you want to watch it. But for those of you who watched, you'll remember that one of the biggest sins is incorrectly assigning beneficiaries, okay? Finally, another strategy that can be used when it comes to RRSP accounts, I mentioned, these can be very heavily taxed. You can use life insurance to help cover that final RRSP tax bill. Essentially, what that would be doing is be making sure that the people you want to inherit your money are actually getting everything you've left for them, and CRA isn't getting everything before them, okay? We will be doing another webinar on that because, again, this is sort of a whole topic, life insurance, so we'll be covering that in an upcoming webinar. So today we learned about, what is a TFSA and an RRSP, how much money can you put into each. We learned that it's not, a super simple number, and it changes every year, and it depends on how long you've been working, what your income is, and how old you were in 1991. What types of investments can you hold in each? There's a wide range of investments you can hold. I probably didn't even cover them all today, but the idea is that you can do more than just high interest savings. You can go sort of as risky as you like or as conservative as you like. Remember that in the TFSA account, though, just as you can create additional contribution room by having assets that grow and don't lose value, you can also lose money in your TFSA if you invest in some things and those go down significantly in value, okay? We looked at whether you should be putting your savings in a TFSA or an RRSP if you don't have the means to do both. But also realize that, yes, you can absolutely do both, and certain circumstances will require maybe that you do both, okay? We talked about the tax implications on death and how some of these tax accounts can be really highly taxed. And then we also talked about different strategies that can be employed in order to, make sure that you're getting the most growth out of your accounts, okay? So at that, I will end the formal part of the presentation. I'm just going to take a quick peek to see if any more questions did come through. I'm not seeing any new ones right now, but I did want to remind everyone that the RRSP deadline this year, I believe, is March 1st. So if you were thinking about contributing to your RRSP and you want to apply it to your 2020 tax return, make sure that you do that before March 1st. And as well, the new TFSA contribution room for 2021 is $6,000. So again, if you haven't contributed already, but we're thinking of doing so, that's something you can do at any point during the year, but as you learned from the webinar, better to do that early in the year, okay? So I'll stick on for another minute or so if anyone has any other questions. I have recorded this webinar today and I will be posting it on our YouTube channel and our website. So, and if you need the link for that, please feel free to follow up, but I'll make sure that all of you get a copy of it as well, okay? Okay, so another question that came up, and again, remember, if you guys have to log off right now, please feel free to do so, but I'm going to continue to address questions as they come up. So I have a question that came through, and it's, if I took money from my TFSA to invest in real estate, Does that mean I can put the money back in as well as max out the following year? Absolutely. So with a tax-free savings account, I said earlier that you can take money out for any reason. Okay, so you can put money in. It doesn't matter what you take the money out for. So if you're taking money out, just say you've contributed over your lifetime $75,000 and a really great investment property came up, you can take the money out in 2021, buy your investment property. Next year, you can put your $75,000 back in, should you have the cash available to do it, plus whatever the contribution room is now for 2022, which I'm suspecting will be $6,000 again. So to answer your question, yes, if you take money out to buy real estate, you can put it back in the next following year, okay? Now keep in mind that holding real estate hard assets, you can't do in your TFSA. So you'd be buying that outside of the TFSA, okay? Okay, great. I will end it at that. I just want to say thank you so much, everyone, for joining, and stay tuned for future upcoming webinars. Okay. Hope everyone has a great day. Bye now.